I'm Tim Quast with Market Structure Edge. Along with me is Edge market strategist Brian Wilson and Brent Slava from Stock Trader Network. Thank you for doing the connection for us. And I have a number of items to cover, and I know Brian does too because I saw what he was. We always talk about it ahead of time. So the 42. I'm just let me take a look at that. Let me make sure I'm looking at the chat. And by the way, Brent, I will try to pause. If there are questions on your side, I will try to, Brian, you and I both do that. Maybe take a quick pause. If there's something that somebody wants to ask, we'll do our best to make up an answer. So, okay, let's see. I want to get to Austin. You said you read 4 to 2 on Modern IR. That's our blog. Okay, so, and I wrote about reducing, I'll cover this really quickly, Austin, since you brought it up. I wrote about, because this has been my profession for more than 30 years, the investor relations profession. That is the function at public companies that's the liaison, you could say, to Wall Street. So, way back, we were the ones who engaged with the sell side. That's the broker dealers who provide, brokerage, and the buy side, the investors who buy stocks. And it's, of course, it's more than that. But quarterly earnings are a big deal. And the SEC has now apparently drafted a proposal to eliminate that requirement to report 4 times a year. Doesn't mean you can't, but we would mirror the Europeans and go to semi-annual reporting. And so, Austin, your question is, I would think it would create less transparency for companies, and it could shift investors away from fundamental trading, which they're right. There's very little of it left. I was looking at the January Morningstar data, passive active data, and I went through this fact for one of our corporate customers. I took them through the top fund families and who's getting the money and who's losing it. And at the top of the list of outflows, Capital Group, far and away the largest fundamental or active shop in the world, big outflows. T. Rowe Price, big outflows. Franklin Templeton, big outflows. I think I mentioned it before. I don't want to spend too much time on this, but back in 2019, the global head of equities at Franklin Templeton told me, he said, I've got 36 buy-side analysts. I got these IR teams and their executives coming through all day long, pitching their stories, and we're not buyers. We're trying to get out of that business. We're getting our lunch handed to us by ETFs. And so you're right. But here's the issue to me, Austin, and the reason why I'm somewhat in favor of it. Quarterly earnings have become nothing but gigantic arbitrage events. I just shared a comment with our professional association, and I used Salesforce as an example. If you look at their volatility outside trading hours versus regular trading hours, and they're blending together, there is slightly more volatility, call it 20 basis points. So maybe they've got 1.8% volatility during market hours and call it 1.6% outside market hours. However, around earnings, and they report outside market hours, volatility explodes. It's 8.1%. And why is that occurring? Well, because, Austin, so hedge funds are consuming all the data. They consume all this quantitative data, fundamentals or quantitative data sets. They will go consume everything, like, all the sales data, the jobs data, the satellite data, shipping data. They have put it all in big models, and they go, we think we can push Salesforce up or down on this data point. And they will make big leveraged bets. And it's driving us crazy because passive money, which has 2-to-1 assets over actives now, what does it need? Products that are stable and not volatile. So you have this catatonic, wait, that's not what I'm looking for. Tectonic, catatonic, I have been catatonic, but so tectonic clash occurring where the interests of public companies, where you have BlackRock, Vanguard, and State Street, and so on, as huge buyers, they need very stable products that track the benchmark, and then we report earnings, and there are these massive bets, and there's huge volatility, and you get taken out of the ETF basket, and your stock does poorly, and you may never get it back. And so I would like to see us change our ways as public companies and try to mitigate some of those arbitrage events. And Austin, I think so much information is available today that I don't believe we will see a transparency issue. Now, I can be proven wrong, but that's my view on it. And so I hope to have that, the issue is issuers are never asked. The SEC and the exchanges go and make these sweeping changes without ever asking the parties without whom there would be no market, public companies who are depending on the market, not for gambling and arbitrage, but as a capital raising tool. Forex, foreign exchange, is not a capital raising endeavor. Cryptocurrencies are not a capital raising endeavor. 0 days to expiration options are not a capital raising endeavor. But the stock market is for public companies. And I think mashing all that stuff together has been very detrimental to public companies. But again, that's my view on it. Okay, so I'm glad you raised the question. So we'll see. We'll see how it goes. All right, so I am supposed to go first here, I think. By the way, if you're tuning in at Stock Trader Network, sign up for our free daily market desk notes. You know, it's free information and it's unique. What's unique about what we do is market structure, the mathematics, the quantitative behaviors, the regulations, the mechanics of the stock market. That's what we look at. Flows, liquidity, and so on. To that point, I want to talk very quickly here about a couple of updates to the platform, and I'll share my desktop. There was a mismatch that has always bothered me a little bit. I will share my desktop. It'll take me just a moment here. We're spinning. Hang on. I have to do that again. Share content. Never seen that button before. So that must be a new feature. Okay, so here's what I want to show you. Again, it's slow. Speaking of slow, one of the things that we updated is the caching. And so it may phase in over days, but we have had a shared caching construct with some other, the corporate business, and we've separated them, and we had to update them, and so it should, in theory, be faster after this. Yeah, it just pushed that update. So that's one thing. Another thing, behaviorally, what we tried to do was square the periods of time that we apply. So you see this, like consumer discretionary. What does this mean when you see lead behavior, fast trading? That means over the last 30 days, if you added up behavioral change, that's the lead party. And so if you created a portfolio where you wanted to capture the key behavior, it's not, so it's, I can see that it has not pushed all the way. You should have, if I'm creating a portfolio that wants to track passive money as the key behavior, well, this and that should match, right? It should. So there was a timing difference in the data. I asked our chief engineer, find out what that is and let's square it. And so we've done it. It'll get pushed out over time, but I wanted to share that with you. One other thing. So Brian and I traded notes with a longtime user who's not currently a user. And he said to me, you know, one of the reasons that I ended up leaving, and I hope he comes back. He said, you mentioned putting an S&P 500 portfolio on the dashboard, and it never happened. So then I ended up going in a different direction. Well, I thought I shared this, but the reason we didn't do that is because there's a licensing issue. We license S&P Global data, but we couldn't use it in multiple ways. We use it in the corporate business so that we can track sector and industry and various other performance for company like, Freshworks, looking at software patterns and tech patterns and what are the patterns in Freshworks, those kind of things. Well, we'd have had to double our licenses and I didn't want to do that. So I think this is a good alternative. And I think we'll put this as a default portfolio. Mega caps track all the stocks. You could do it. It's a very simple, it has a single criterion that says market cap equal to greater than $100 billion. So to be in this set, you got to have $100.1 billion of market cap. And so it's the fascinating thing is it captures most of the market. It captures close to 8. I mean, it's going to vary, but at the moment, 80% of market cap is showing up in this portfolio. And as I pointed out this morning in the note, this, It's weak. It didn't even get back to 5 at March options expirations, and now it's trending down. Yes, the supply side is too, but when they move the same direction, sometimes it can even be worse than if they're converging, because it can compound volatility. And
Hey,
so I
Tim,
looked at that and
can
said,
you share your screen, please?
it is sharing on my side. Are you not seeing it?
Oh, no, it is on mine as well. One of our uh,
It
participants
should
said they
be
weren't seeing your screen. Yeah.
it should be sharing. Yeah. So if not, it might be, one of the things that you can do. I'm going to get rid of that. Okay, so you could pop this screen out that I'm sharing. I can't show you here, I guess, but you can pop it out so you can see it better. It might be that you're just not seeing the window, as it were. I mean, and that might have been what I did. Maybe it was a window instead of the norm. But hopefully you can see. My point is, if demand is weak, that's an issue. And you see it maybe showing up today. You could, have other things that you might point to. But I said, I think that this is a potential issue. And, we'll see how it goes, but we'll put that on the platform. Speaking of data, I have one other thing to share with you, I think, and then I'll hand this off to Brian. But it is I call it an experimental portfolio because we haven't done this before. But I think it's in keeping with the things that we like to do, which is we want to try to capture, where's the money going? The advantage of market structure is you can see where the money is going. I'll return to the desktop for one last thing to point this out. But this portfolio looks for I like large cap. So the market cap range greater than mid cap. So it's large cap and mega cap. And we want 3 standard deviations of demand supply divergence. I mean, so you have diverging demand and supply, core principle. When demand and supply diverge in any market, prices have a propensity to rise. Not perfect. There is no perfect platform, but it's a pretty good principle. Key behavior is equal to passive. Passive money buys characteristics, what stocks share in common. Active money buys what makes them different. The problem is the money buying the herd is massive. You add up Vanguard and BlackRock alone, or Vanguard and iShares alone. In the trailing 12 months, those two things, Vanguard's equity business and iShares, which is it's the ETF unit of BlackRock, just the two alone, $700 billion of inflows trailing 12 months. And you juxtapose that with $70 billion of outflows from Capital Group, what constituency should we be paying attention to? The one that has money. And so we look for passive money, and we exit only if the sentiment trend declines or passive money is no longer the lead behavior. That's it. So doing that year to date in this portfolio produced, where is it? I mean, it's up almost 13%. Now, it's got more components. Instead of 5, we expanded it to 10. So there's going to be a little higher turnover that can be off-putting, but it does a very good job of figuring out where the money's going. And that can help us outperform. We change the basket if the behaviors in the market are no longer helping that basket. And it will be a principle for us. If a portfolio is down, call it 5, certainly 10, 5 to 10%. Well, why are we doing that? That portfolio is not working. Thus, we've put the focus on the take 2%. Take 2%, focus take 2%. That thing is up. And so it's a way to figure out where's the money going. We're going to find it in momentum stocks and take 2% in the portfolio, just like we do with daily trading ideas. Okay, last little thing, and Brian, I'll hand this off to you, is I want to go back to the dashboard really quickly here and make this point about where the money is going. What I wrote about today was there's a lot of divergence. I mean, you can find it. This buy 5s thing is another thing that says, well, let's find stocks that are at 5 and have declining supply. That looks good. You look at communication services, demand's getting awful close it's not quite back to 5, but it's not bad. And supply is declining. That's a divergence. Good divergence in consumer discretionary, not consumer staples. See, that's tipped over. This looks like mega caps. And big tech, really weak. I mean, if you put it all together, you say, well, there are a lot of good things in the market, But the bad things to me outweigh it. Even though broad sentiment has risen back close to 4, there's no oomph to it. This is not what we had in a momentum market where you have 30 choices in the daily trading ideas momentum portfolio and everything goes up. This is not the condition we have right now. And so I'll stop there. Brian, hand it off to you, and we can talk collectively about what's ahead.
Tim, one thought for you, maybe before I take the reins. Do you have any thoughts on SpaceX or the securities which have exposure like DXYZ or VCX?
Well, I think it's a clever strategy, even though it's controversial, and the SEC would have to suspend some of its rules. Is that a good idea? Should you make a bunch of exemptions to your rules? What I'm talking about is SpaceX has gone around and said, if we can pull off this IPO, we will do it provided that we have support from big passive investors. And under the SEC rules, that's not possible. It takes a while before passive investors can own these things. Well, it's where the money is. The IPO market is broken. It doesn't work. And the big reason for it, in our view, as quantitative data analysts, is passives need data to know how something is going to perform in order to include it in an ETF basket. And that flows will go to. Well, there isn't any data. And so IPOs are driven purely speculatively, and they show a strong propensity to fall because you can't have a sustainable gain in stocks as a central tendency unless you have passive money, because they're the big buyer in the market. So we'll see. It's a good idea what they're trying to do. I don't know if they'll pull it off. That's a partial answer.
Terrific.
Okay.
Thanks, Tim. I'll go ahead and share my screen, kind of talk through a few topics here. And as Tim mentioned, we'll kind of circle back at the end to kind of talk about the path ahead. I think I will begin with one of the questions that was in the chat room. It was talking about the potential setup to last March and the movement lower. This was a move lower of almost 5% that particular day. So for those who are new to what we're looking at here, what you see in green here is what we call broad market sentiment. In blue, where gray is SPY. And what we had in the lead up to, and I'll call it the tariff drama for lack of a better term, this is actually a slightly different setup than this year. It occurred roughly at the same time. What you're looking at here at this rectangle is end of month activity. So we had this occur right at the beginning of the month. In fact, let me get you the exact date here. I have it highlighted. 4/3 was when it occurred. The market lost almost 5%, lost another 6% the next day. Now, there was one fundamental difference between this setup and the one we had back there. I track big tech every day. Big tech is roughly about a third of the S&P 500. Look at sentiment for big tech right before this occurred. It was really strong. Now you can see it very rapidly deteriorated. I don't remember big tech deteriorating like that before. So that to me is one of the key differences between right now and back then. Is big tech was much stronger. One other difference is the market was actually above neutral at that particular time. So we were above neutral, and what we then saw. So here's where we're at. We're above neutral, and then once that tariff news hit, look at that rapid deterioration. Unbelievably how fast that occurred. So I would say similar right now in that we're approaching month end, but broad market sentiment was in a different place. You can see it was actually above 6. And here we are right now below 4. So very different in terms of broad market sentiment, and actually very different in terms of the big tech setup as well. And I think that's part of the reason why we got hit so hard because we were extended from a sentiment viewpoint. When we get above the red line, I think of it as stretched. The whole market is just getting a little bit stretched. We were stretched right then, and we were just really susceptible to that particular news event. I was actually thinking of covering this later, but I'm going to cover it right now. Speaking of news events, and I just tossed this in Copilot, just an AI question. The topic is relevance and novelty. So I asked it, like, how do I evaluate a Truth Social post from a relevance perspective and a novelty perspective? And you'll see this not occasionally, you'll see it all the time with relevance and novelty moving stocks. You'll especially see it with earnings. If you have something that the street was not expecting, you can get hit incredibly hard, to the tune of stocks down 20% or what have you. What's happening when that occurs? That's the machines taking everything lower. There was something that got scored with a negative novelty, negative relevance, negative sentiment. Sentiment is another one that you can put in there, and that will move things. Now, what I'm interested in, and I haven't seen it happen yet, right now, when the president makes a post, well, it's moving the market in a positive manner, right? So it seems to still have high relevance and high novelty. So those are market moving events. I think this is just me speaking. I think at some point, some of those posts are not going to be as high novelty or high relevance. In other words, the president comes out with a post and says, peace talks have started, and the market goes ho hum, and absolutely nothing occurs. I'm making this up, but you get the point where relevance and novelty, and at some point that probably wears off. If it does wear off, I mean, I'm concerned about the market if that occurs, and I'll share two reasons why. Tim has been talking about this recently. Big tech is about a third of the market cap for the S&P 500. Well, big tech is weak. Okay, so big tech is weak. It really contributes to the market going nowhere when big tech is weak. Another reason that I'm a little concerned about the market right now is the fact that behind the scenes, our daily read for broad market sentiment is kind of grinding to a halt. So this is what you see every day for broad market sentiment. Right now it's 3.9, but you can see behind the scenes, that's really slowing down. We were moving higher, kind of screeching to a halt. That's a little concerning to me. So if I'm positioning myself for trading in this environment, I see broad market sentiment that might roll over already after just a brief move higher. And let me show you, what this looks like. If we look at this move higher, we've just started moving higher. Will it stop already? If so, that could potentially be bad news. We've had a little bit of short covering, and this is short volume down here. Short volume has gone down, Tim. I think it was like 9 days in a row. I'm trying to remember from your note this morning, 8 or 9 days in a row. That cycle's probably
whole cycle.
Probably about
whole
over.
Average cycle. Yep.
So if that cycle of short covering is over and broad market sentiment rolls over and big tech is already weak, well, you can see the dilemma that's being presented there. So how I'm approaching trading then, if we get lucky on days like this, it's not occurring right now unless the market is rallying. Markets down, markets the opposite of rallying, down 1.4%. When we get down days like today, right now could change. We've been seeing up days, the next day. Now, if I'm going to directionally bet on an update tomorrow, well, I know the whole market is slanted lower right now. I'm not going to make a big bet on an update. I probably will bet on an update tomorrow. How would I do that? I'd probably buy SPXL. That would be my way of betting on that. But I'm not going to make a big bet because we already saw that directionally the market is slanted a little bit more the other direction. Daily trading every day, and I would encourage those who don't have access to this. You can get access for $9.99 a month, an easy way to try some of these things out. But on our daily trading ideas, I will sort by probability. And then what you're looking to do is you're looking for but coming in between the entry low and the entry high. And let me show you how I approach this. So I will drop those just quite simply into a watch page, and then I'm going to look for opportunities. And the opportunities are going to be between those parameters. And on days like today, when the market is weaker, one thing that I'm going to look for are things that are bubbling to the surface that are positive. Here's an example, FTI. Energy play, we know energy is positive right now. Even though the market is much weaker today, well, we're having a hard time keeping FTI down. I'm going to seriously look at that at the end of the day today as a possible buy. So that's a way to think about that type of trading. A couple of days ago, I bought Wolf. Let me show you what this looks like if I can get to the top of my page. And this is a good example in two different perspectives. So Wolf had made a really nice move higher from 1510 all the way up to 1619. I mean, that was a huge move higher in that particular day. The next day, it kind of held its ground. You can see that it was basically trading sideways. Well, I bought it that day because it was a little bit of a consolidation. It was on our daily trading ideas. It roared higher by 6 or 7% yesterday, and I sold it. So, a good example on two different ways. It was in our daily trading ideas. It was one of those names. I'm like, well, it's consolidating, but it wasn't, it wasn't immediately moving a lot lower. One of our adages that we have is, take gains, not chances. If you have a chance for 6 or 7% gain, well, you take that, you say, thank you very much, on your way to the bank. One other topic for me today, and then I'll get into my ahead look. I actually mentioned this yesterday, and Tim mentioned it for me in the daily note. I was a little early to the program, but we're seeing a lot of software names getting moving higher today. And let me show you what you can do with any space that you want to. I chose software a number of weeks ago because it was in the news all the time. So I just created a portfolio and I just took the 10 largest software names. Is it a perfect representation? No, but it's pretty good. And then what I did is I, dropped that into a portfolio. I started buying it back in here when sentiment was, like almost completely oversold. It got down to 1.6. It really didn't start to rally until we got up into here around 3.3, 3.4. And then the whole software space just exploded for about a week and a half. I mean, great example. Sometimes with sentiment that is really oversold, you can buy those. I mean, just recognize a couple of things. It's oversold for a reason. Will it make its way back to neutral and above? There was no guarantee that would happen. It did in this case, which was great. I made some name. I bought IGV and I bought a couple of just software stocks. Made money in all of those. But you have to be aware. When sentiment starts to slide again, software's been terrible. Once again, if you're buying in here, well, probably be aware that it might be choppy for a little while. We haven't bottomed yet from a sentiment perspective. I think it probably goes higher. I can't guarantee that. But it would probably take a few days to fully play out. Hopefully that makes sense. Tim, are there any questions that I've missed before we take a look at the road ahead?
Yeah. Let's see. There's one in particular. When was this? It's for you. Oh yeah. So if Max, I probably answered that. It was is Brian, is your sentiment that you just showed, is it a real-time read? And I explained that that
Mhm.
it's a daily read that then we average. We create an average because, as with many things, daily reads can be very volatile, and one day is not a pattern. So officially we use and if you correlate them, highly correlated, and you're not missing something by having daily versus the average read. The average read is I mean, the reason we use it is because it's a better read. However, we're aware that, as Brian pointed out, we creaked up maybe 0.6 of a point yesterday in the volatile read, and that's not a great sign. I mean, the market could tip right back over again. That's the issue there. Okay, that's I think it. And holler if we've missed something. Oh, Martin, let's see. How likely or often have you seen news Trump quote unquote sentiment? It's a very good question. It can happen.
Mhm.
Brian, you might go ahead, weigh in on that.
Oh, I mean, we've been seeing it recently, Martin. I would say some of the Truth Social posts, we would say we're generally in a weak environment, a weak backdrop. And some of those posts, what's interesting, and I think Tim mentioned it in a note recently, is that you get positive news coming out from the president, the market takes off. Iran says, no, that's not happening, and the market's not even responding to what Iran says. Um, so I think that would be an example recently where those Truth Social posts are kind of trumping, I would say, the sentiment setup.
Max, you said so it seems like 3.9 might be the top. I mean, on a trend basis, it probably goes to 4.1 or 4.2. But the problem with that is that it's not even back to five. A lot of the time we use what's called the 5-5 rule, that over a longer range time, buy things when they rise over five and hold them till they return below five. So, you buy at five, when it returns to 4.9, you're out. Statistically, and we've done a lot of data science on that, and you can use what we call profiler to do that, works really well. And so if the whole market can't get back to five, it's a problem. That's part of the reason I have, and again, keep this in context, that it's not my total return, because I'd had periods back last fall that weren't great. But in the last month, my volatility trades up 31, over 31%. Year to date, the portfolio is up 28%. And I've really looked at these conditions in the market and concluded you should trade daily trading ideas, but when demand deteriorates, be careful. You can trade them now, but realize that demand is pretty weak. And then those shorter term directional SPXL, SPXU, volatility trade. If there's a nice move in volatility, maybe short volatility. I'm not saying they're challenging things to do, and we can only do them because we can see demand and supply. And most of the time, it is right. It will tell us what will happen next. Because if you just watch the market, you would think, oh, we had a great day. The market must have strength again. And well, we're looking at the underlying data and saying, no, it doesn't. And which thing is correct? Well, sure enough, the market has struggled, and we're very aware of it because we can see it everywhere. And those are conditions that you can use to your advantage for tactical
Mhm.
trades like that can work quite well. These are unusual circumstances. Under ordinary, whatever that is, circumstances, I just use the model portfolios and trade daily trading ideas. And then at inflection points, then maybe long short, but it takes all the thinking out of it. Okay. That's all I've got. I think I've already, you can wrap us up, Brian, because I've sort of expressed my view repeatedly.
Sure. I've kind of talked through my view already a little bit, but I think Martin had a question about sticking with sentiment.
And Brent from STN. If there is a ticker time, somebody wants us to look something up and comment on it, we can do it really fast. We're a little over time. Apologies for
Yeah.
that. Yep, we can do.
Martin had a question about
And
sticking with sentiment over news. And let me go ahead and show you an example of what that might look like.
and
So
Steve will come to you.
thank you. I shared with you earlier how, I mean, it's not a great setup right now. Big tech remains weak. If we look at, broad market sentiment, we've had these up days, right? But, the general trend has been lower. So, we would say it's a weak setup, and, the market has been doing what should occur in a weak setup. It's been moving lower. Do you have these up days? Yes, absolutely. But the general trend has been lower at this particular not at this particular time. As I look ahead, big tech is weak. Broad market sentiment might roll over. I already mentioned that. To me, we have some downside risk, but I would say watch out for Truth Social posts until they no longer become relevant. If they lose that relevance, if they lose that novelty, then you could really see a weak setup really start to manifest. Right now, they do remain relevant. We're continuing to see upside days when the president does make those tweets or whatever you want to call them. So I would say the risk is to the downside, but watch out for the post at this particular time.
Steve, we'll finish with you. What you got?
Big question. Is the SEC going to do the investigation? Who investigates after last Friday when 15 minutes before the announcement by Trump that there was, I forget the exact number, mega millions of dollars invested in the oil?
I saw that too. Yeah.
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 So who does the investigation on something like that?
Well, if they're equity instruments, and there were ETFs, I think that were tied to that, then it's going to be the SEC. If it's oil, it's going to be the CFTC, the Commodity Futures Trading Commission. And I don't know. I haven't. I heard Jay Clayton, U.S. Attorney for the Southern District of New York, so the Paul Giamatti from
Right.
Billions, right? Say that they were going to look into it. That's all I know. Don't know beyond that. But obviously it was highly correlated, wasn't it?
Yes. How can we possibly be righteously investing in a stock market that is that corrupt?
No, it's an issue, and even if it's just data, this takes us back to flash orders, leading into what we call the flash crash. And Scott Patterson, who's now at Bloomberg, but he was a Wall Street Journal reporter for 2 decades, and I know him reasonably. And he wrote a couple of books on the market, and he was the one who identified these flash orders where you would get a split-second look at an order if you were paying for the top data feeds. Well, is the same thing happening in these futures markets? I don't know. But there would be nothing stopping an alternative trading system from offering a proprietary feed that was like 400 milliseconds ahead. And so is that it? Is it corruption? Or is it speed? Or is it something else? And I hope we find out.
Well, at 15 minutes, that
has to
15
be
minutes
human.
in advance.
Right.
That's not milliseconds. That is having information well in advance.
Yep.
So
I don't disagree. Yeah.
Okay.
All right, you guys. Good to see you. Sorry we went long. Brian and I were both long-winded today. Yeah. So we'll try to be sharper next time. By the way, I'm out for a couple of weeks. I've got a sailing trip, as you know I like to do. So we're going to go to St. Bart's and then sail around St. Martin and Anguilla, and Brian and team will hold the fort. But usually when I leave, something goes haywire. So maybe you want to short the market here. Just kidding. We'll see you in a couple of weeks. Great to see everybody. Thank you, Brent.
Thanks.
And
Thanks,
STN.
Tim.
Bye, guys.
You betcha. See ya.